In this video, you'll learn a spread trade setup. You'll get some quick background, a setup example, trade entry and exit points, and finally a risk management comment. This setup takes multiple days to resolve itself. Spread trading reduces volatility. Often, shorter-term price movements aren't significant enough to justify exiting a trade. When compared to other futures trades, this setup has a lower-than-average risk-reward level. Of course, all spread trading carries risk. What is futures spread trading? It's the simultaneous buying and selling of related futures contracts. The setup we'll discuss uses the same futures market. One delivery month is bought and another sold. This is called a calendar spread. Let's look at Eurodollar futures. The daily closing price for the April contract are shown in blue, and the June contract in gold. Same market, different expiration months. If you're only buying or only selling, you obviously make or lose money based on the price performance of that one position. In this case, either the blue line or the gold line. With a spread trade, where you are buying one and selling the other, it is the relative performance between the two positions that determines profit or loss. An important underlying principle is that spread trades reduce volatility and risk. Here's our Eurodollar price chart again. Notice how similar the patterns of the blue and gold lines are. In the highlighted area, the price of the April contract rose significantly. The June contract matched it. Likewise, in the second highlighted area, when the April contract plummeted, it was shadowed by the June contract. When external events move the market, both legs of a spread trade are often affected somewhat equally. When you buy one of these contracts and at the same time sell the other, volatility and explosiveness are diminished. By the way, a nice side benefit of this systemic risk reduction is lower margin requirements. Sticking with the Eurodollar example, we've magnified the scale to show the amount of spread between the April and June contracts. A technical trader might note that as the spread between the two contracts neared the 0.12 range, it hit resistance. And as it dropped to the 0.09 range, it hit support. This created opportunities to grab small gains as the spread approached either of these barriers and then reversed. This pattern leads to trade entry and exit points. The two lines depict spread resistance and support. If the spread approaches resistance, then the earlier month contract is bought. At the same time, the latter month contract is sold. Conversely, if the spread approaches support, it's the late month contract that's bought and the earlier month that's sold. Let's map out a trade assuming the spread hits upper resistance. At this point, a calendar spread trade is entered, with the earlier month contract bought and the later month sold. Stop losses are tight. Target profit is not overly ambitious. This setup is geared towards small, repeatable profits, which brings us to a comment on risk management. A common pattern in spread trading is a series of small gains. This occurs as two related markets move in somewhat tandem. This is often followed by a large loss, taking back all those gains and perhaps more as an eventual unrelated movement occurs. Limiting losses is a cornerstone of all futures trading strategies. It's even more important in spread trading, where you're tempted to lower your guard as you get comforted by periods of relative predictability. Click below to subscribe and get updates for upcoming futures trading education.